from the market and of course from experts,
Mm-hmm.
and then be able now
Sorry,
to
Superior,
apply
we
that
are
to my
recording.
life.
Mm-hmm.
I'm saying I really would. Of course, we know that money and time are both. Those are not in plenty, and so I would
Yeah.
like to be a bit wise on where to invest. And of course,
Mm-hmm.
I realize this is a very good avenue to learn from the experts from the industry.
Yeah.
So I'm here with an open mind just to hear and learn and just know how to invest and if how to be wise about it. And
Yeah.
I'm very open, like an open book.
Awesome. I love that. I like the openness. And there's somebody who said that it's very important that we have the humility to accept that we don't know so much, and the curiosity to find out what is it that we don't know, and how much is out there that we can learn. Thank you so much. And I feel that is the attitude you have, Superior, as you come into this webinar. Thank you so much for sharing that. Awesome. Let's clap for Superior. There's some emoji there. If you look, there's that button for reactions. You can just use it to clap for Superior for sharing in that manner. Anyone else would like to share what you're expecting tonight? Can I call names, or would you like to volunteer yourself, or I volunteer you? Let me see. Jackie Wanyoike, I'm volunteering you. Please share.
Thank you so much for the opportunity. Yeah, of course, just looking forward to learn and just to know what is in store for us, considering the times we are living in. And of course, just getting to learn from the experts so that when we are making decisions, we make informed and wise decisions. Thank you.
Wow, thank you, Jackie, for sharing and being bold to speak. People don't like speaking. Yeah, I don't know why, but it's a good opportunity. We have Jen Maigua. Would you like to share? What are you expecting? And anyone else, please type in the chat. What are your expectations tonight? Just type in the chat. Tell us, why did you join? What are you looking forward to hear as we wait for, what's her name? I just called her name. And now it's disappeared. Jane Maigua. Jane nakuona. Jitokeze.
Hi. Good evening.
Hi, Jane.
Yeah, nice to be here. Well, I don't think it's any different from the ones who have spoken. I guess it's the same thing. Just want to learn from the experts on, gain more insights and more
Awesome.
in-depth understanding of this, or the return to the investor.
Wow, great. Thank you so much, Jane, for sharing. Please, ladies and gentlemen, please type in the chat, what are you expecting tonight? So that we know whether we're going to be able to meet your expectations or not. I need to hear from a gentleman. There's a guy who joined here at 6:30, Kibiru. It means that he was very eager. Kibiru, please share with us. What are you expecting tonight?
Hi. Well, I guess I was expecting not to be volunteered, but here we go.
That does not mean you don't be coming early.
That's okay, but thank you. Thank you for putting this together. What I expect from this is to learn the different products available for investments and the best return on investment based on one's individual needs. I think one size does not fit all when it comes to investments, and I've realized I think you're approaching all land, treasury bills, bonds, and you brought the issue of the dollar rate as well. Then if someone is outside the country, is it best not to invest back home, or just to invest in the country in which they're in. So I'm expecting to learn. Thank you.
Awesome, awesome. Thank you so much, Kibiru. Please, the rest of the team, please type in the chat your name, where you're joining us from, and what you're expecting tonight. It will be so good to know if we are meeting your expectations or not. For now, it's 7:10, and I would like us to begin our session tonight so that we have enough time to have this conversation. To begin with, I'll introduce myself. My name is Eunice Maina Mburu. I'm the Chief Sales Trainer at 20X Entrepreneur, also the founder. And I'm sure you're wondering, what is 20X Entrepreneur doing with the investment? I'll just briefly share who 20X is. 20X Entrepreneur is an organization that accelerates businesses and people to grow their income. When you talk to salespeople, when you talk to business people, we talk about revenue, growing. The business people are about growing their revenue. For the salespeople, are about growing their money. And for you who is here, we talk about growing your investments. And therefore, we focus on getting money to your pocket. All right. And one of the ways that we do that is we do sales training and coaching for business owners, entrepreneurs on how they can enable their salespeople to sell more. And we also do training for salespeople. On how they can be able to sell more effectively at such, difficult times, at times where there's so much information available there. How can salespeople sell better? The other way that we help businesses grow is through sales management. So we, organizations outsource us to manage their sales team. Basically, it's like saying, Eunice, you sell for us, as we'll focus on what we know how to do best, which is to either manufacture or to develop and design products. And you just do what you know how to do best, which is selling. And the other way that we do the same is we recruit great salespeople and connect them with organizations that are looking for salespeople. And finally, we realize that there's an aspect that we need to address, the aspect of investment. When you talk about growth, you can see 20X
Eunice, are you there? Eunice, are you there? Hi, everyone. Please give her a minute to be back. Her network just went off. Thank you.
Because we want to. You're here because we want to help you also grow the money in your pocket. And at this juncture, I would like to invite our first speaker, who is Jerry Ndirangu. Jerry, are you there? Please welcome Jerry with some.
Hi, Eunice. I'm here.
Hi.
Attack after attack.
Can you be visible? Ah, there she is. Thank you, Jerry, for joining.
Mentioned specifically in the book of Joshua, the 11th chapter.
Okay, sorry,
There's three
we need to
areas.
mute some people.
I think there's someone who needs to be muted. I don't know.
Yeah, let's mute them. Yes, we've done that.
Okay.
All right, so I would like to welcome Jerry. Jerry is, some of you may know Jerry, others you may not know her, but she's an expert when it comes to the money market, investments. She has been head of business development in Britain for many years, then Madison, and now she's advising organizations on where to invest money. So Jerry, take it away.
Thank you, Eunice. I'll start off with something because I was given a brief. It's an introduction session, so I don't want to bring out the jargons in investments. So I'll start you off on an intro, and then later on we can actually get into more details. So just to kickstart, like I mentioned, this is an intro bit. And even as we proceed with this, there's something that I had prepared just to give an intro about who we are. And this is something that I think everyone will be able to listen to.
Jerry, you need to share the sound.
You can play the video from your end, or
okay, let me
are you able to? Okay.
Give me a minute, let me pull it out. Yes, I can do it.
Out of 10 adults lack the basic skills to manage their money effectively. Today, we're going to change that narrative. Welcome to Ujani, a journey of financial literacy, where we'll uncover 5 key points that can transform your money management skills. Imagine a young girl named Amina living in Nairobi. Amina just got her first job and she was thrilled, but soon she found herself living paycheck to paycheck, never seeming to save enough. That's when she realized the importance of budgeting. Budgeting is the first step to financial literacy. It's about knowing your income and expenses and planning how to use your money wisely. Amina started to budget, and soon she was able to save for her future and enjoy her present. Now let's travel to Lagos, where a man named Chijioke runs a small business. Chijioke was making profits, but he didn't understand why his money seemed to disappear. Then he discovered the concept of taxation. In Africa, as in the rest of the world, taxes are a part of life. Understanding taxation can help you know where your money is going and how to plan for it. Once Chijioke understood this, he was able to manage his cash flow better. Now meet Fatima from Accra. Fatima was a savvy saver, but her money was just sitting in a savings account, doing nothing. That's when she learned about investing. Investing is about making your money work for you. Fatima started investing in local businesses, and soon her money was growing. We move next to Gaborone, where a young couple, Tumelo and Neo, were drowning in debt. They didn't understand how they got there until they learned about credit. Credit can be a useful tool if used correctly, but it can also lead to a cycle of debt if not managed well. Tumelo and Neo started to understand their credit and began to manage it effectively. Finally, let's visit Kigali, where a woman named Yvette had a decent income but was always stressed about money. She realized she was missing one key aspect of financial literacy: financial planning. Financial planning is not just about money, it's about life. It's about planning for your future, your retirement, and your peace of mind. Yvette started to plan, and soon she was enjoying her life more. In conclusion, financial literacy is not just about money, it's about life. It's about knowing how to manage your money so you can live the life you want. So, why wait? Start now. Join the Ujani Investments Academy. Learn about budgeting, understand taxation, start investing, manage your credit, and plan for your future. It's a journey, and the first step is always the hardest. But remember, the journey of 1,000 miles begins with a single step. So, take that step today. Your future self will thank you.
All right, Jerry, over to you.
So we are a financial literacy firm, and what we are doing is creating financial literacy amongst the Kenyan population, both in Kenya and also outside Kenya. And to kickstart this, I'll talk about Ujani on another day, but I just wanted to mention some of the ideas that we have about investment opportunities that are available in Kenya. Okay, so if you look at my screen, we have the NSC, we have land, we have circles, which people actually look at them as investment opportunities. We have banks, we have government securities, that is the treasury bills and the bonds. We have real estate. So today we're going to touch mostly on the government securities and real estate and land as well. Then we have unit trusts, which are currently known as the money market funds being offered by the fund managers. Then we have offshore investments, and we also have businesses. So investment opportunities can be represented in quite a number of ways. And today we kickstart off with government securities, land, and real estate, or rather real estate and fixed income opportunities, because I felt that would be key in looking at where we can invest. I'll also touch a bit on the unit trust investments. So before we even start on this, one needs to look at their risk appetite. And as the saying goes, high risk, high return. And your risk appetite just means, do you have the shock absorbers to be able to absorb a loss in your investment? If you don't have those shock absorbers, then leave the riskier investments alone. And we stick to there's what we call the low risk or the middle risk investments. And as you can see, high up here are the options, futures, and collectibles. In Kenya, we don't even have such at the moment to offer, but we have fund managers that offer this. In the most developed world, I can say USA, China, London, these are actually available in those markets. And if you look at middle, this is where in Africa, most of us are, and in Kenya, that is the bonds, real estate. Mutual funds are the money market that I was talking about. Stocks just means the shares that are in the NSE. And then at the base, what we call low risk, we have cash and the government bonds. So to proceed, let me just touch on what real estate is. And according to us in fund management or in the investment world, real estate is actually property, land, buildings, and air rights above the land and underground rights below the land. So it starts off from the vacant land, any industrial building that you may have, commercial building, residential building. So all this is actually what we call real estate. That's why if you see someone who is, say, offering borehole services, they still have to pay government because you're actually mining from the land, and the land belongs to the government. That's why we actually pay taxes to the government, because this land, it actually belongs to the government, okay? It's just that you hold a title to that ownership, but if you're going to mine, that's why we have mining rights. We have, you have to pay a fee if you're going to be drilling water in your piece of land. You have to pay the government for that. And I'll speak to each one of them and the opportunities that are available in each and every sector in Kenya. So according to our trends and opportunity, there is quite a rapid urbanization that is coming up in Nairobi, as well as the metropolitan. So there is a trend, or rather there is an appetite for you to actually come in and participate in real estate. There's also what we call a tourism potential. We've seen even local travelers that are currently promoting our region or representing opportunities where you can come in and offer Airbnb You can be able to invest, say, in small hotels, or what we call the inns or the inns and the motels, where you can be able to actually attract local as well as that is domestic and foreign tourism. So there is potential in that. Again, if you look at what's happening currently, we've seen quite a number of malls coming up, not the big malls, but the smaller ones. I'll talk about Isili area has one of the biggest malls that has come up. We've seen smaller malls that are being developed in estates. It could be areas like Kilimani in Westlands. We've seen areas like Kiambu Road. We've seen small malls that are coming up. And that means that there is an appetite for you to actually participate in this. Office demand, with an urban development coming in, tourism potential, there's retail expansion, there's going to be demand for offices. Because remember, during COVID, it was all a policy of working from home, but we are now seeing people coming back to the office because that work from home policy has already passed. And now there's more demand for people to come to the office. There's more demand for you to go out there, meet your customers, engage face-to-face. And also that physical presence is currently being felt in as much as we've already passed that working from home segment. So we are seeing this as an opportunity in real estate that people can actually partake in. If we look at some of the benefits of getting to invest in real estate right now, lucrative returns, and here we are talking of returns. If I'm talking about gross, I'd say between 7 to 15%, depending on whether you're purchasing land or you're doing property development or you're utilizing that piece of land, okay? And then we're also seeing a rise in property values, especially in the urban areas and the metropolitan. And even with devolution happening, we've seen this happening, okay? Wealth diversification, it provides you with an opportunity as opposed as previously when I can say everyone was looking into real estate, we all thought about land buying. So you buy land and you hold it and speculate. But what we've seen is when you just buy land and hold it, land is currently appreciating at a rate of 0.5 to 1% per annum, not like previously where it used to appreciate at 5% per annum. So you'll find that if you're not utilizing that piece of land, by the time you're thinking you're going to sell it, it's going to actually come at a lower price than you bought it at. So what we normally advise anyone that if you're going to invest in land, then you need to utilize that piece of land so that it's able to make you a return, okay? And if you look at why we also advocate for real estate investments right now, steady cash flow. Remember, if you're going to own a residential or commercial property, there's rental income that's going to be coming in. So it's able to provide you with a passive income stream where you're just earning on the rental yield that you're getting from your tenants or that you're getting from your commercial property. And by commercial property, we've also seen people going into storage or warehouses. So these are also some of the new real estate ideas that people are venturing into, where you can actually earn from it. And here we are talking about storage. So you might be providing storage for a manufacturing company or someone who's moving goods or someone who wants to keep storage of their goods, and they pay you on a monthly basis because that is where they're going to be storing their produce, or that is where they're going to be storing their hard products as they sell the stocks. Tangible asset. This is one of the things that Kenyans love. And tangible assets, I can just mention something, a finding that was done by Knight Frank. Currently in Nairobi only, we are holding about 1 trillion of Kenya shilling in just land alone. Remember, this is land that has not been developed. This is land that is bare. So imagine this piece of land, if it were to be converted into cash, I doubt we will see all these troubles that we're having at the moment with the Kenya shilling and the dollar and the all the issues that we're having even with oil and the inflation rates that you're talking about. So when you talk about a tangible asset, Kenyans love land. Na ndio maana ukisikia roti maguta, everyone runs to that piece of land. And it's because we've been raised to believe you need to hold that land because it gives you financial security. This is something that you can pass on to your children. So it becomes a source of generational wealth that you can pass it on. So that belief in that aspect, real estate has also been looked at one of the areas that people would love to put their money in. However, I cannot mention benefits without coming to the challenges. So number one is the volatility. Remember, there's all these fluctuations in demand. Today you bought land somewhere in Kisaju. No one wants to even go to Kisaju. You've bought land somewhere in Kajiado. When will your children even think about going to Kisaju if they're living, say, in Nairobi or they're living in Kitengela? So they're not even looking at that. Looking at construction costs. Right now, if you're planning to put up a building, you need to cater for at least 30% of what you want to put up will go into your construction costs. That is the licensing, building plan, there's approval plans, there's architectural, there's NEMA, there's NCA, all these things. And don't forget, even at site, with your site manager, the people who will be working on site will be stealing some of these people, some of these materials. So again, you need to have careful risk management if you're going to do this particular investment. Remember, even in land, like I mentioned, the liquidity, this market volatility brings that issue of liquidity when it comes to real estate investing. If you have an emergency right now and you have, say, a building with 82 bedrooms, okay, and you need to be admitted in hospital, you cannot liquidate that property immediately for you to go and pay for that, or rather pay for your admission costs. So even when you're trying to sell, nowadays, if you try to sell a property and it takes maybe a year, 2 years, I've seen even 3 years, by the time someone is getting a good buyer to buy it at the price that you want. And remember, you're going to use a broker that will be both on the side of the seller and the buyer. There's also costs that will be incurred. We know capital gain has come in. So whatever you're going to transfer, you have to give the government its piece. So looking at some of this, it's bringing about that volatility and also reducing the demand of why people do not want to invest in real estate anymore. Land acquisition, securing land for development again can be quite challenging. Number one, remember the procedures. Right now, I don't know if land registrar has already sorted out their issue, but they were moving to a new system. So it also brings those delays in terms of you don't want to acquire land, you don't want to develop it, and then something just delays and it eats into your project. Encroachment concerns. Remember, you might want to purchase this land, you've already purchased it, but we have people that are encroaching into that particular settlement. So again, it becomes a court fight. Oh, these are squatters, they've been here for 30 years, you need to chase them away. It becomes an issue. Construction costs, I think I've already mentioned about this. And then regulatory compliance. Remember, like I mentioned, if you're trying to even develop, you need to get all these licenses and all these approvals. And also looking at some zones where you'll be charged a certain percentage, if it's urban, if it's rural area, or if it's a metropolitan Nairobi, you still have to go and get license from them. So again, some of these things need to be looked into for you to be able to be successful in real estate investing. So those are just some of the challenges. I'm sure others will come in. However, there's a positive side because we have the government providing us with some incentives and policies to encourage people to enter into real estate. And already we have some tax incentives, property registration, like I mentioned, now we are moving into the digital era, and also looking at these business reforms. In as much as, yes, they're introducing more taxes, they're also looking at, can we invite more people to actually be able to convert this idle land to be able to be quite productive. Remember, the Affordable Housing Initiative is also something that is very keen and very key to developers and investors who are able to benefit from the incentives and subsidies. And like it's mentioned, yes, you'll be able to create employment to the youth or the masses that are within those areas. Then infrastructure investments, we've actually been seeing this, it has been happening. That is number one, roads. We've seen smart cities being developed. I think Tatu City is one of them. Connectivity, we've been able to see this. And what happens is, even with devolution coming in, we've seen some of these services being transferred to the county area. And we've seen emergence of even some properties that are mirroring properties that are also in places like Nairobi or the major towns, Nairobi, Nakuru. So we've seen counties that are also developing and unlocking such potentials. Another thing is the development of what you can call TVET, colleges, and also universities in most of these counties. That has also brought in, with the students coming in, there's also need for us to house services that are going to be provided to these students. We've seen all these level 4, level 5 hospitals that are opening up. These doctors need to be housed. These doctors need facilities. We also need hotels. If there's going to be a hospital somewhere, tourists are coming in, it needs to be upgraded to be able to provide. I'm sure you've also seen the way, I think it's Equity Afya, yes. They've been able to open a clinic in each and every county. Again, this infrastructure that is also enticing and telling people, okay, fine, if there's an equity, I can actually agree to go and work in such a particular region because I know my health is sorted. If I go to that region, I'll be able to see, oh yeah, there's a need for housing at this place and I need to develop rental units. So these things are just unlocking that potential in this particular region by those infrastructure investments that are coming in. So strategies for you to succeed in real estate, you need to do thorough research. You need to work with people that are already there. You need to analyze the trends. You need to look at the news, what's happening, and also look at the high potential locations for your investment. You don't want to go and put up a residential apartment, and then immediately after you're done, a Chinese comes and puts up his. Most likely it will be more modern. It will have free Wi-Fi. And then you see all your tenants moving to that new block. So those are some of the things, even that competition brings about, it can actually lower your returns in this particular investment. Networking, again, work with real estate professionals, developers, agents that are there, property managers, gain insights on some of these things. We've seen what has been happening with the diaspora families out there. Yes, they want to come and build. They give money to family, and what happens? They take a photo of their neighbor. That is what they send to you and tell you that is what is happening. So we need to be working with professionals. We need to be working with people that are actually giving you a status of what is on the ground. If you can build your network, and when you're building, come and stay in Nairobi for at least 6 months or 3 months, so that you're able to ensure that your property has gotten to this level, it's being managed properly. And this is something that I've seen, especially people who are doing quite well in real estate and they're based outside the country, they are able to actually even minimize the losses that occur. Risk mitigation, diversifying your investment, due diligence, and then have reserves. Once you've developed a property or you've developed, what are they called, rental units, when it comes to servicing those rental units, it again falls back on the landlord because you're supposed to do service at least every 3 to 5 years, painting, plumbing. It has to be maybe the doors, the hinges. It has to be maybe inside the properties. You're the one to actually maintain them. So when you become a landlord, you also need to have a sinking fund that takes care of such, because immediately the outlook of that particular building, whether it's commercial or residential, it starts to drop. They go to a newer looking premise. So you actually lose out. You start losing out on your income. Then have a long-term vision. I know what you're saying here. You need to focus on sustainable growth. What are you able to offer these tenants? Okay. What is the cash flow generation? How are you able to park your money? For example, during COVID, I know a lot of people were not working, but if you looked at that period, there were some landlords who were even giving a consensus and telling the tenants, you can actually pay me 50%, which means you as the landlord will actually also look at your expenses cutting down like that. But again, remember, we have those standing costs, fixed costs that come in. Well, maybe it's water, maybe it's agency, maybe it's maintenance of a borehole that you actually drilled into that particular property. So you need to have a buffer that will be taking care of such expenses when they're coming in. And also for us, during elections, what normally happens, we are about to just go into elections in 3 years' time. You've put up a property, say you've put up a residential property in a place where there's going to be some commotion. And you also need to foresee that at that period, a lot of people will want to move and go to the village. A lot of people who will be working in that region will want to run for their safety. So some of these things need to be overlooked. And also as you're building, look at that long-term solution and also the risk mitigation factors that you're going to be working with. Now, before I moved as I move to introduction to fixed income investment opportunities, I'll mostly touch on the government securities. These are just the treasury bills and bond. But you also need to understand, why do the governments issue these bills and bond? Number one, they're used by the government to raise funds for various projects. So treasury bills are normally short-term. And short-term means it's a short-term lending to the government where the government is telling the public, we need money for this particular, it could be to pay salaries, it could be to balance their budget. And these are the short-term lendings. They're called bills, treasury bills, okay? Now, bonds are normally long-term. They're normally long-term, 1 year plus, okay? And normally they go towards an infrastructure development and long-term projects for the government. So number one, government financing, debt management. Remember, right now we are talking about the Eurobond. Oh, will the government pay? Even as they pay the Eurobond, they will still need to refinance, okay, and get more money to be able to take care of other projects. So they may issue a bond, like right now they've been issuing bonds. I think every 2 weeks we are seeing a bond being issued or a bill being issued where they still need to finance their existing obligations. Like I mentioned, could be salaries, it could be ya mafuta wanataka kulipa. So they will borrow from the public, wanalipa, then they pay back to the public. Again, to attract investors. Remember, various projects are able to give various returns. For example, if it's an infrastructure bond and it's going to the roads, they'll put up a toll station where they'll give they also go and give presentations where they'll say, we are building roads on this particular region. Let's take, for example, Nairobi Kitengela, and we have the ETC and MTC where we're going to be charging this much, and this is what we'll be getting. Same idea that came out with SGR. We want to provide this service, and people will be paying, and then we'll pay you back at a certain return. So it also works to attract investors into the country. And that's why when you hear we've been given a negative report by these people called Moody, it actually creates that risk that, oh, the government might default, which again pushes our bonds to a higher price, because the risk of default means it's the same way if I was to borrow you money and, for example, you know I'm not going to be working the next 2 months, you'll tell me, by the way, you need to pay me within a month. And then you'll charge me a slightly higher return because you know this person might not pay. So that is the same thing that happens with the government. If the investors feel, Kenya might not be able to pay, they'll charge you a very high interest. So you're going to be seeing bonds that are floating with very high returns because that risk of defaulting is what is pushing the price up. Okay. And again, demand. Right now, the government needs money. So there's that demand. And us as the investors in the investment world, we're also telling them, if you want our money, we want to dictate our return. So again, that demand and supply comes in where we are able to argue on the prices of these bills and bonds. But remember, bills are short-term, 91 day or 92 day, and then we have 182. That is 3 months, 6 months, and 1 year. Now, types of bills, I think I've spoken about this. Treasury bills, these are short-term, and treasury bonds, these are long-term, and normally they go towards a certain project. These are the infrastructure bonds. Treasury bills, I have already mentioned, and then infrastructure bond, these are normally for bigger projects. It could be an infrastructure bond to build a dam. It could be to build a road. It could be to provide a service like electricity. It could also be to just do a project like Wi-Fi, providing Wi-Fi in all the counties. So they issue a bond towards a particular project. And normally for infrastructure bonds, they go between 2 years up to 20 years. Treasury bonds, they also go normally 3 years all the way to 20 years. So why invest in the government bills and bonds? Number one is stability. Remember, if the government was to default, what would happen? They would actually just go and print more money and pay, or they would actually tell you, we can roll over that particular investment for another 2 years. So number one is there is what we call stability in terms of it's a stable investment with a lower risk compared to other forms of investment. Fixed income, remember when you invest in a bond, you're going to be getting periodic interest paid to you. Every 6 months, the government will be paying an interest to you. For example, if you buy a bond at 1,000 and the rate is 10%, they'll be paying you 100 every year, but it's paid every 6 months. So you'll be getting 50, 50, 50, 50. I'll show that in the next slide. Again, it's able to provide a diversification. Remember our pyramid, which was saying high risk, high return. You should also explore investing in the treasury bills, because looking at currently our rate of return in the bonds, for the treasury bills, I think right now it has hit about 15%. For the bonds, we are seeing bonds that will be issued as high as 17%. For seeing 19 might not be such a shock for us in investments. So those are some of the things that we are looking at. And again, like I mentioned, it's a low risk. It's a low risk investment where we are definitely sure the government is going to pay us, especially for the shorter term investments. Push for a good rate of return. You're paid every 3 months again. You roll over like that. So some of the factors to consider before investing, the market conditions. So evaluate the conditions and the interest rate trends before investing. I've already mentioned our rates at the moment. Lowest we are getting is, I think, 14 or 13 thereabout. Highest we're getting is about 15. Issuer credit rating, like I mentioned, if the government gives a bad credit rating to the country, it pushes the bonds quite high. But at times it also shows that there's a risk of defaulting that is about to happen. We've had what's happening in Ghana. They defaulted in everything. It was the Eurobond, it was the local, it was everything, and they said we want to restructure. So it just means everything now collapsed. They cannot pay you at all, and you start afresh. So that's it. And when that happens, it means even the government itself is not able to print money to pay you as the local investor. However, the way we are looking at Kenya, we are not heading that way. We are also not heading the Zimbabwe way. Remember, with Zimbabwe, if you have, you become a billionaire even with 1,000 bob here in Kenya. So we are not foreseeing that. And we are looking at ways to be able to regularize the inflation rates. We have the fiscal policy that is always meeting every 2 weeks to also look into this. But again, this is something that you need to carefully look at. Investment horizon, again, if you want to invest for a short term, below, say, 1 year, I would advise you to invest in the treasury bills because that is less than 1 year. So you can choose 3 months, you can choose 6 months, or you can choose 12 months. However, for the bonds, if you're going to invest in the bonds, you have to hold these funds until they mature. Remember, for you to be able to invest in this, for treasury bills, currently is about 100K, yes. And we have the Emakiba, which is offering 3,000 for you to be able to invest. And that 100K you invest in multiples of 50,000. So remember, if you're going to invest that 50,000, it has to stay there for 3 months. You cannot pull out before. If you're going to invest in the bond as well, it trades in multiples of 50. And if you invest in a bond, which is longer term, for 2 years, you have to hold it until that period. What you'll be earning is just the interest that is paid to you every 6 months. So you'll get your 50,000 at the end of your 3 years. On the 3rd year, that is when you'll get your principal, but the interest will be paid regularly. Let me just show that. I think it's in the next slide. No, not this one. So I think I've already mentioned the risk and returns of investing in the bills. So the risk factor is it's quite low risk. Factors like inflation and interest rate may affect the return. We have an inverse relationship between the treasury bills and the bonds. When our interest rates go up, the bonds come down. So that can actually affect your investment. For example, with current interest rates being at, I can talk about with a bond going at around 14% and interest rate coming at, say, 16%, you see you'll be holding a bond that is lower than what is currently being offered in the market. So you have to hold on to this bond for the next 3 years, as opposed to you removing your money and coming to invest in the short-term interest rate. So that actually affects it. In terms of returns, yes, they offer competitive returns compared to traditional savings. And this is something that we've seen is actually happening and also providing you with a return on your investment. So this is how you earn the return. And like I mentioned, we call the interest income coupons. And these ones you receive on a regular basis, that is every 6 months. There's also the redemption value. And again, this redemption value can go up or down depending on the interest rate. And then we have capital appreciation. So if the market value increases, you can actually sell them at a premium. For example, if you're holding a bond that is at 16%, and we have a client who wants to come in and buy at, say, the demand right now. For example, people who bought, I think it was 2 weeks ago, they bought a bond at 17%, okay? And we have a new investor who would want to come in. You see, at that point, you can actually be able to tell them, fine, I know I'm holding a bond at 17%, but if I look at the coupons that I'm going to earn, I can sell this bond to you at 18%. So at that point, you're able to realize a 1% on your investment. So that is what happens in the bills and the bonds. And again, the market value is normally driven, like I mentioned, by the interest rates. So an example here that I'd put is the Kenyan government has issued a 10% infrastructure bond for 3 years in December 2022, and you come in and invest 1,000 bob. So what will happen? Remember I said you're paid every 6 months. So in June, you'll be paid 50 bob. 10% of 1,000 is 100. So you'll be paid 50 bob in June, 50 bob in December, 50 bob again in June, December, like that. And then in December 2025, the government will pay you the 1,000 bob and your 50 bob coupon at that point. So that is how the bonds work. So you're actually sure that for the next 3 years, every 6 months, I'll be earning something. And at the end of that period, I'll be paid my face value and also the last coupon. So that is what happens. And at times, if the bond you're holding, the rate will be quite high, you might find that your face value is no longer 1,000, it's now 1,100, and you also earn the 50 shillings. So that is what happens with the capital appreciation in the bond. And also that is how the coupons are paid in terms of what you're going to be receiving as interest income over that period. So this just shows the investment opportunities that are there in the market during a market downturn. Remember, we are looking at, number one, regular income or passive income. It's not money that you're going to be looking at the Nairobi Stock Exchange every time. You're not going to be holding your stomach all the time in terms of, will I get a return when it comes to this? And remember, like I mentioned, we want to put our money where we feel, even if I'm to sleep at night, my money is still making more money for me. Okay, so number one, we have the money market funds that are being offered by fund managers. A money market fund is just an investment that goes into the government treasury bills and the bonds for investors who are not able to go directly to CBK to invest. Remember, for you to go directly, you need a minimum of 50,000. Number two, there's also liquidity. So for a money market fund, number one, they offer you liquidity in the particular aspect that you can access your funds within 2 working days. So if you need your funds, say you had invested 2 months ago, and you were actually not sure how long you want to invest, and you want your money, they pay you within 2 working days. If you look at the returns, the lowest we've had this year is 8%, highest currently is 12%, and we've seen fund managers that are offering even 13% at the moment. Number two is you're able to earn a return on a daily basis. So there's a power of compounding. Remember, if you look at treasury bills and bonds, for treasury bills, you have to wait until 91 days for you to earn your return. Now, what happens with the money market funds? They are able to invest in various fixed income securities. Remember them, they are coming in large masses. So as you invest your 50,000, then they are going to the government with 200 million. So number one, they are able to trade in between, okay, the periods and earn returns and pack them and offer them to the public. So normally, if you do not have the 50,000 to start with, or you don't want the hassle of going to CBK, or you feel, okay, I think in those 2 years, I might need the money in between, we normally advise you just go to a money market fund, invest there. When you want to pull out your money, you can pull out and do whatever you want to do with your money. I think the only con here is choosing the wrong fund manager. We've seen what happened to, I think it was 2020, where one fund manager was divesting the funds into real estate, which again brought some issues in the industry. But this has now been regulated by CMA, so we are not foreseeing that happening with any fund manager at the moment. Infrastructure bonds, again, here I'm talking about both When I talk about infrastructure and bonds, I'm talking about even the T-bills. So at this time, this is offered by the government, specific terms, 91 days all the way to 20 years, attractive return, and we've seen current interest ranging from 13 to 17%. The only con, it is not liquid until maturity. And again, we advise this is medium to long-term portfolio, or rather assessment. So you invest between 91 days all the way to 20 years. So you will hold these funds until they mature. Again, when we go to real estate, we are looking at land buying, land utilization, property development, rental units, and commercialization. Commercialization actually just means if I have a piece of land, I'm able to develop it into a commercial property, or I'm able to commercialize that piece of land to ensure that it's giving me a return and the land is not lying idle. So apart from land buying, you're just not buying land to speculate. You're buying land to actually utilize it. It could be farming. I mean, agribusiness is something that has now become, I think it's become a trend currently, in terms of people are putting small greenhouses. Once they buy the pieces of land, you drill a borehole, you start supplying water. That is also commercializing your piece of land. Some of the cons, it is speculative, high capital if you're looking at developing, mismanagement by agents, again, illiquidity in terms of emergency. And this one I mentioned, even if you're holding 80 acres of land and your son has been admitted, your dad has been admitted, you cannot sell it immediately within 2 days to be able to access this particular service. So those are some of the issues it brings. That's why we like to say, start divesting. You can have land, yes, but you can also have liquid investments. Could be in the T-bills, in the bonds, in the money markets, okay? Competition, I already mentioned. You put up a flat, then you get one of the two people that are currently #1 in real estate. I think we have the Chinese and then we have the other developers, and they put up mesmerizing apartments, and then you see all your tenants moving there. So those are some of the issues. Also mismanagement by your development team. We've seen apartments that are just falling all over. And again, who's supposed to incur that loss? Who are you going to charge at that point? Because this is a project you've actually put in your money into. Then we have a new investment, a new vehicle that was launched, I think 2 years ago, which is called a real estate investment trusts. Now operates, gives an opportunity for investors to invest in real estate. However, you only get to own a unit in terms of shares. So for example, Serena Hotel can issue a rate on Serena Hotel, but you will only be able to purchase shares into that particular hotel. So this in the developed world is something that has been happening. And you'll see that most of the big hotels or even hospitals, they fall under a real estate investment trust. In Kenya, the only ones that we've seen are functioning is the Kwetu student hostels. And if you've looked at most of them, they've been offering a REIT called VUCA, where I think the minimum to invest was 10,000. I don't know if they've reduced it to a lower amount, but you're able to earn a dividend on it and also capital appreciation. In terms of return, it gives a return of 8 to 12%. #1 con in this particular investment is choosing the wrong REIT. You can go and invest in a real estate investment trust, and that time they may be investing in a mall. And then that mall just does not have tenants, or that occupancy of that particular mall is 50%. So you'll find that your returns will also reduce based on the tenancy. It's actually pegged on tenancy. So most of the REITs are pegged on tenancy. And then tax treatment. In some countries, they do not have a tax, what we call, it's not a tax-free investment. So at times the fund might not be taxed, but the individual is taxed. So you also need to look at how the REIT is structured. Again, not many opportunities in the country. Currently, only 2 fund managers are offering this. This is Aecon and Kwetu Student Hostels. And then we have ICA that are offering the Fahari REIT. But again, with the Fahari REIT, they've already locked out individual investors. They say they only want institutional investors. So again, it brings out the story of liquidity, because most retail investors do not understand what real estate investments are. So liquidity might actually be an issue because a lot of people are not taking it. Then we have what we call the fixed deposits or flexi fixed deposits. And these ones are being offered by banks and a few fund manager. Normally has a return slightly higher And if you look at the return, it's 11 to 14%. And then it's structured according to 10, I think 3 months, 6 months, and 12 months. And with fund managers, they're able to give you a slightly better return because remember, as they're investing in large sums of money because they're managing not only individual customers, but also corporates and also funds for insurance companies. So they're able to actually use the economies of scale to get higher returns. Number one con on this is, or the disadvantage is choosing the wrong financial institution or fund manager. Again, normally taxed unless you're tax exempted. For this, you'll be taxed between 10 and 15%. There's a penalty for early withdrawal. So it's not casting stone that when you put your money there, it's held until maturity. Most of the fund managers normally charge a 1%, 1 to 3% of that fixed deposit if you want to pull out earlier than the period that you had agreed upon. So these are just some of the areas that I looked into in terms of where you can invest during a market downturn. I don't know how we are doing on time, but this is just an analysis, what I've spoken about and the returns that they're offering at the moment. If we look at cash at bank, risk profile is low, liquidity is very high. And here we are saying put money in the bank that you feel you're going to use below 1 month. For bank deposits, again, depending on how much you have, but if you go there with your 1 million, at times, the max you can get right now is about 7%. And again, it's a short term, 3 to 12 months. Risk profile is low, liquidity is also high. Treasury bills, we are talking about 10 to 13%. I think I said we've even hit 14 right now. Risk profile is low, and then liquidity is also quite high in terms of you have to wait until that point when it matures. Unit trust, I've given the range as well, and we've seen them hitting 13 right now. Risk profile is low, liquidity very high. T-bonds, we are talking about a low risk profile, very good returns at the moment. Liquidity is medium. Remember, you can trade the bonds in the secondary market. And if you have a good broker at that point when you're selling, you can actually sell at a good price, or you can actually sell at a discount, which means you're going to get less than what you had put in at that point. Then we have our stocks. And right now, I like to put in that range. You can do a negative 20 all the way to a positive 20%. And then for stocks, it's not a short-term investment. Normally, we talk about 5 years plus. And then land and property, I put in the net returns because if you're buying that land and it's not doing anything for you, even that 1% ni kama manna from heaven, you'll be getting about 0.5 because you're speculating. And then if you look at the net return, if say you have tenants who are coming in, I just looked at agency costs. I think there's also landlord tax that has come in, property tax, which has come in. And depending on how much rent you're earning, it also dictates the kind of tax that you're going to pay. So on a net basis, we are looking at a return of about 7%. And this one I'm very conservative because we've seen clients getting as high as 12%, especially for developers. People who do development, they can even make up to 20% on a certain project. So it's not casting stone that's the fixed number on this. And in conclusion, what I can just say is, number one, you need to look at a secure investment. We need to diversify your portfolio, like I mentioned. Secure investment just means get enough information on what you want to get into. If you do not want the headache of dealing with tenants, of dealing with your agent, of dealing with all these issues when you're developing the property, then look at the other options that I've mentioned. Diversify your portfolio. Yes, land is good, but if that land is not making money for you, we need to diversify our portfolios to ensure that generational wealth is also created. Then consider your goals. Are you looking at short term? If it's short term, I think like emergency fund, holiday planning, and school fees, those are things that you can park your money in a money market fund. Do a regular investment plan. If it's money that you feel, okay, I will not touch this money for the next 5 years, then you can explore a treasury bond at that point. If it's an organization, you've seen organizations that are also going into treasury bills because they feel that is where their money is safest. And some are even dictated in terms of, okay, we don't want to deal with any other party, we just want to deal with the government. So you'll find some organizations are also going there for their short-term or the long-term goals. So those are some of the things that we need to look at. And even as you're considering your goals, consider your age. I'm very key when I talk about age, because I would not want someone to invest their money and by the time, say, you want to access this money to do one or two things, it becomes an issue. Or you start wondering, how am I going to sell this piece of land to take my child to high school? So we also need to plan very well so that, you know, at this stage of my life, I need to be consolidating all my pieces of land I sell so that I can have near cash. As you enter into retirement, you need to start divesting from land that is not making you money. You need to have near liquidity, which is, you need to be near liquidity, which is cash. Because remember, upon retiring in that journey, you always need to have money at hand, because some insurance companies are not going to accept you because you have those, what are they called? Pre-existing conditions. So you need to handle some of these outpatient cases. At times you may have family or dependents that are depending on you. So you need to have cash at hand most of the time. So looking at your age, looking at your risk appetite, and also consider what you want to do with your money. Eunice, I think I'll stop there and invite the next speaker, or we continue with Q&A.
Okay, thank you so much, Jerry, for that. You can stop sharing the screen. Ladies and gentlemen, I'm sure you agree with me that it's really packed and we can't finish this tonight. And before we ask for questions, please type your questions in the chat. I would like to invite, Jerry has talked about all the type of investments, and you know, if you want to invest in money market or in bonds, you can either, you know, talk to Jerry, or you can talk to BSmart. They will be able to do that. Now, we have George Murodhi, who has joined us. And as Jerry has talked about land and the kind of investments you need to make, for those who still feel that land is, you know, an opportunity for them based on the information given, George, where are the opportunities currently, or what would you advise, especially those who are, you know, looking to invest for speculative? What would you advise at the moment? Karibu, George.
Good evening, our participants. My name is George Murodhi. I'm a director of a real estate company with the name Masons Realtors Limited. We offer land investment opportunities. After such an informative session on the various investment vehicles, another point that we've taken away is a matter of diversification. And once you weigh your investment options, and you still feel that you want to go the hard way for what has been called the long-term return on investments in the long run, we are the people to go to. As Masons, we are members of the Real Estate Stakeholders Association. This is a new formation to get rid of the fraudulent land dealers. And if you want to check whether the credibility of any company that is actually dealing with land, like you said, you just text the company's name to 23878, and you get a response where the company is registered with the stakeholders who are vetted, and you know whether you're dealing with the right people, and that is get rid of fraudulent investors, such that your money will not you'll not lose your money. So for us, we'll actually be brief on what we have on offer. And if you choose to go into land, we say, of course, you can start from the entry point to the speculative point. And at the simplest, the least you can invest for you to invest in land with us is actually 200,000. For these, we have properties in Nanyuki and in Matu. And today I'll briefly talk about Matu, where we have plots, 50 by 100 plots that are going for 250,000. Matu is actually a sub-county of Machakos County. It's actually in Yata constituency. It is 60 kilometers from Thika, along the Thika-Gariza Highway, is actually en route to, actually is actually almost to, actually in between Machakos and Kitui, en route to Garissa County. This is our first developing area where actually, according to the land ministry reports of 2020, is that Machakos County recorded the highest number of title deeds issued in the year 2020. And these were majorly issued from Matu sub-county. As an investor, there should be a reason to ask yourself, why should it be that the most titles were issued from Matu, or actually from Machakos County, and in particular from Matu sub-county. Matu has a lot of fundamental reasons why you need to invest over there. First and foremost, from the proposed expansion or the dualing of the Thika-Garissa highway, that will bring a lot of infrastructure projects in Matu. And Matu, when you talk of 60 kilometers, is a place you can actually build, do business over there, or do business between Nairobi and Matu. You can actually build in Matu and live and work in Nairobi. There has a lot of been other proposed infrastructure projects like the cement factory, which was actually launched by the former governor, that is Alfred Mutua. And you can imagine what a cement factory will bring into this economy. Of course, the employment, the affordability of construction, and other factors. And of course, now to be easier to build, the population will grow, and any other reason for growth in view of our property over there definitely will grow. There's a lot of water is plenty, electricity is plenty, churches are there, all infrastructure projects. That is, you may name it, whatever you want to say, talk about. And for the reasons Matu becomes across the place to invest from Nairobi. We have properties in Matu that we are selling at 250,000. But since we have one project that we are opening up on this coming Saturday, and in this webinar, we want to make an offer that whoever will do the site visit on Saturday, we shall be offering the same at 200,000 per plot. We have other projects near Nairobi, that is in Juja, which are going for 600,000. These are ready for buy and build. And we have other properties at Watamu, that is at the coast of Kenya, where we have properties near the beach, virtually less than a kilometer from the beach, that are going for 600,000. These are 50 by 100, and these are quite ideal for holiday homes, Airbnbs, and retirement homes. So for more information, you can visit our website, which is www.masonsrealtor.co.ke. You can visit, you can check us at Facebook, at Twitter, and Instagram. So once again, my name is George Muruthi from Masons Realtors Limited. Thank you, Eunice.
Awesome. Thank you so much, George, for that information. There's an offer if you're going for site visit on Saturday, 250K off the amount. So you can go and see as you evaluate your best option. Please type the Masons website on the chat for people to check it. Also type, Jerry, please type your website on the chat, and also Be Smart for those who want the money market. Please type on the chat. Now we need to answer some questions. Please give us just 15 more minutes. We'll be done by 8:30. This is not our normal way of doing things. We end by 8, but today I think it's been very packed, and that's why we are taking longer. So there's a question from Walter. Jerry, what vehicle can I invest in for 3 to 6 months with the best interest? That is from Walter Kubai. And then we have another one, which you can rejoin. What do you look for in a good fund manager? How do you hedge for inflation in the current market? So you can start with the first one. I'll read for you the other two after. Jerry?
Okay. What investment vehicle can I put 3 to 6 months? Okay. Walter, between 3 and 6 months, I think we have 2 options. Actually, 3 options. Number 1, you can look into investing in the treasury bills. Okay. Because right now, with the kind of inflation rate that you're having, if you look at the rates of return, they're doing quite well. You can also, again, depending on your, what I can call need analysis, how far, or your liquidity needs. Should you wish to get the funds in between, then I would advise you go for a money market investment with a fund manager. Number 3, you can also look into taking up an investment, either in a high yield savings. But right now, if you sorry, not high yield savings, what we call the high yield fixed deposits that are being offered by, currently, I think it's only 2 fund managers that are offering this. And the only caveat in that is you need to have $1 million and above, because I know those 2 fund managers, they'll give you a very good return. You'll fix the funds for 3 months or 6 months and get a slightly better return than what you would earn in a money market. And if I was to talk about the rates of return, for the treasury bills, 3 months is going for up to 14.5%. 6 months, I think it can hit even 15. Then if you, but again, one of the downward bit of this is you need to hold the funds until that maturity. Oh, okay. And then for money market, this one, at least the rate of return will be around 12% to 13%. The lowest I've seen in the market for money market funds for that particular period is, I think, 10%. So you can actually place the funds there. And then, like I mentioned, you can go to the fund managers that are offering the fixed deposits, depending on if you have $1 million and above, and you can be able to earn a return of up to 13 to 14% at the moment. So the second question, what do you look for in a good fund manager? Number 1, I'd talk about look at the product offerings that they have. Number 2, you can look at the assets under management, and assets under management will actually guide you in terms of how much they're holding, retail as well as institutional customers. Number 3, look at how long they've been in the market. And also try to look into the news, even go to Google and ask about any scandal that this fund manager has had. And normally they pop up because you'll see someone has complained about so-and-so. What are some of the issues that they've had? Number 3, look at the return. What you'll see is the rate of return should be, if the treasury bills are offering, say, 15%, 14%, a fund manager should be able to offer something not higher than that, but slightly nearer to that. So I'd talk about a fund manager offering, say, 11 to 13% is in the green for me. A fund manager offering, say, below 10, I'd be a bit on the amber, but I'll also get to look at, is it a big fund manager? Because big fund managers, say fund managers that are currently holding 200 billion and above, might not be able to give such a high return, but you know your funds are safe with them. Like I'd say the number 1 fund manager at the moment, I think it's CIC, then we have Britam, Old Mutual, and so on and so forth. If you look at their rates of return, they will be maybe slightly below 11, but if you look at the stability of that company, it's been there for quite a number of years. They have a good assets under management. They have a large client base. They have a large distribution, just that the investment component that they took might have been those bonds that were being offered at, say, 7% or 8%. So it might be a bit difficult for them to move from that low return to come and join the new bonds that are in the market. But you'll see the newcomers in the market are able to give you a slightly higher return. And you can actually make a decision either to walk through this journey with the new fund manager, such that by the time their rates are dropping, you also move to another one. So here you'll have to, it's a catch-22 situation. If you want to go for stability and you're comfortable with earning 11, then you can go for the big fund managers where they'll offer you that stability. I mean, they're managing quite a large number of customers, and your funds are going to be okay. If you're going to be chasing return, then you need to look at who are the upcoming fund managers, who is running this company, have they worked for any other company before? Do they have a good reputation in the market? Then you can now invest product with them. I think the last one was how do I hedge for, let me see, for inflation during the current market. Okay. So as an individual, I normally like to tell people With inflation, it just means there's a rise in cost of goods. And remember, your salary is not going to go up. It's not going to match that inflation. So number one, if you're going to look at hedging for your inflation, you need to start saving either in a high yield investment. Number two, you need to look at developing another source of income just to supplement what you're earning. Number three, you need to cut on your expenses. So you have to decide what you're going to be looking at. So for you to hedge against inflation, cut on your expenses. Whatever you've cut on is what you're going to project and put in a high yield. Because when inflation rate is high, look at the way the treasury bills are performing. Look at the way these money market funds are performing. They're giving a quite, they're giving a high return to the investors. So you need to take advantage of that. And you also need to find within your financial plan, where am I able to cut my expenses so that I have some money to put aside. So it also comes down to budgeting. So that's what you can do to hedge, and then add your income. So you need to look at what am I able to develop personally. It could be a hobby that you're very good at. It could be cooking. It could be going online. Or I think there are also online courses that you can be able to do and also earn on that. And Eunice is a guru in that. She can guide you on what areas you can get into. Yes.
Well, thank you, Jerry. Yes, if you're looking for extra income at 20X Entrepreneur, we have a lot of opportunities. It just, you just reach out to us and we will, look at your circumstances, because again, you don't want to divert your attention from your core business, your core job. So we will evaluate you and see which opportunity suits you best. So just reach out to us. And just to remind you that if you left the correct phone number when joining the meeting and your email address, you receive a recording for this meeting. And you will also, a few notes on, summary of what has been discussed. You will receive it. All right. So I think that's all. The number of, that's all.
Oh, sorry, I've seen a question on HISA app. The only concern that I've seen most Kenyans have with the HISA app is on the fees, especially if you're going to buy shares in US companies. And also, you also need to look at which are these performing companies in the US. Currently, we have the tech, we have pharmaceuticals, but you also need to do an in-depth analysis on the shares that you want to buy. So one take home is the fees that are charged on the app for HISA. Do you mind sharing the two fund managers offering? Currently, the two licensed fund manager is Britam and Madison. And I think, Eunice, this one you can handle. And I mean, it's Kiokondolo. Yeah. So we have Madison Investments. We have also African Alliance. I think I've seen 13% on that. And also
CIC.
Britam. Yes.
And CIC. Or
yes, and CIC. CIC for the fixed deposit, they normally do an offer. So I think they'll be able to do this month.
Yeah. All right. So ladies and gentlemen, I know you want more. Please type in the chat the next topic you'd want to discuss when it comes to investment. You're dedicating every Monday, 7 p.m. to discuss investments. So you can, and we want to discuss all the topics that you want. We'll be inviting experts in those fields just to talk to you about where do you need to invest? What should you be thinking about? And of course, we'll also discuss the opportunities for you to do business that will not take you away from your job. So type in the chat, and if you're not able to type today, you can send on our, I think our contacts have been shared. Faith, have you shared our contacts on the chat? Please share, Faith or Derek, share on the chat. And this brings us to the end of our session tonight. We've gone 25 minutes above time. Next Monday, we'll try and keep it up to 8 p.m. And it's just an introduction, as Jerry said. We were doing introduction, and now you know that we'll be doing this every Monday. We'll be here to discuss that. And on Thursdays, we normally discuss sales. So you will choose where you want to be at. Thank you so much. Have a good night. And please remember to go for site visit and get your plot at 200K only. After that, there will be 250.